Hello everyone, today our topic is camping and trading CO2 emissions. More and more fossil fuels are being burned to fuel industry growth. Tons of greenhouse gases have been discharged, and this is causing global temperatures to rise. Scientists believe that catastrophic and irreversible changes to our environment, including rising sea levels, droughts, and floods, will occur if global temperatures rise by more than 2 degrees above pre-industrial levels. This is otherwise known as the 2-degree threshold. Carbon dioxide is the primary greenhouse gas emitted through human activities. Here is the trend of global CO2 emissions from 2005. As we can see, emissions have grown sharply over the past decade. As such, this 2-degree threshold is likely to be breached in 30 years if the current trend in emissions persists. This is thus an urgent need to reduce CO2 emissions now. Cap and trade emission trading schemes have been put forth as a cost-effective, market-based approach to reduce emissions. Here we'll discuss how the scheme works, its merits, implementation challenges, and complementary approaches to reduce emissions in light of these issues. ETS seek to reduce emissions in the following manner. Firstly, consider an economy that has two industries. These are their pre-ETS emissions level. The government caps overall emissions below their existing level by issuing firms permits. These permits are tradable. As such, firms can either decide to reduce emissions to meet their cap or to increase their allowable emissions by purchasing permits from other firms. One of the key advantages of ETS is that they shift the burden of reducing emissions to those who find it least costly to do so, hence lowering the overall cost of reducing emissions. To see how, assume that Industry 1 can reduce emissions at $5 per ton, whereas Industry 2 can do so at $1 per ton. Industry 2 can find it profitable to reduce emissions at $1 per ton and sell its excess permits to Industry 1, since the latter will surely be willing to purchase them at a price that's less than $5 per ton. Hence, emissions reduction is undertaken by those who find it less costly to do so, thus lowering the overall cost of reducing emissions.
In addition, ETS places caps on emissions, thus offering certainty over the quantity of emissions reduction. This stands in contrast to imposing carbon taxes which do not provide such certainty. To illustrate this point, consider the diagram here. The vertical axis represents cost, while the horizontal axis represents the level of emissions abatement. Under an ETS, a cap that reduces emissions by Z star brings about such an effect. There is no uncertainty about the outcome. However, the level of emissions reduction is uncertain. When a tax of T is imposed, if a firm's private marginal cost of reducing emissions is PMCL, the firm will choose abatement level ZL. This is because the private marginal cost of reducing emissions is lower than paying the tax T at abatement levels below ZL. Hence, the firm will continue to reduce emissions till T equals to PMCL at ZL. On the other hand, if the firm's PMC is PMCH, the abatement level will be ZH. Given that firms' private marginal cost of reducing emissions is hard to determine, the level of emissions reduction under a carbon tax will thus be uncertain, unlike under the cap and trade ETS. Now let us look at an example of ETS success story. The U.S. sulfur dioxide trading scheme that was introduced in 2005. With the scheme, sulfur dioxide emissions dropped by 68% by 2012, and the overall cost of emissions reduction was just a quarter of what was originally predicted. While these are arguments for implementing an ETS, we should highlight that ETS face several implementation issues. Firstly, ETS can fail to provide incentives for firms to reduce emissions if the permit prices collapse. In fact, European Union ETS permit prices have collapsed twice since the scheme's inception. Two reasons lead to these drop-offs. Firstly, initial caps were too high. Early on, instead of checking data on emissions, European regulators trusted firms to tell them how much greenhouse gas they were emitting. Since those numbers would be used to set the initial emissions cap, companies had an incentive to exaggerate, and they did. There was thus an oversupply of permits, causing permit prices to collapse. Secondly, the recent financial crisis led to a slowdown in economic activity and emissions. Despite this, the EU kept releasing carbon permits even as the decline in output meant that fewer were needed. As a result, there was an excess supply of permits, causing permit prices to tank yet again. Given that permit prices may collapse, mechanisms are needed to prevent them from happening. In this regard, regulations can either set price floors like in California ETS, or temporarily reduce the supply of permits. EU regulators are considering this option to boost the low permit prices.
While price collapses may be avoided, it appears much harder to overcome another issue that ETSs face: carbon leakage. Carbon leakage refers to ETSs causing an increase in overall emissions when businesses, faced with higher operating costs imposed by an ETS, shift production to countries with laxer climate policies. As differences in environmental cost pressures motivate carbon leakage, leakage may be avoided by equalizing these cost pressures across countries. This may be done by, firstly, taxing the carbon content of imports. However, such a scheme faces several implementation challenges. Firstly, the importing country may suffer from a welfare loss when taxes are set at too high a level. This can happen when the process of imposing taxes is dominated by powerful industrial groups seeking protection from foreign competition. Secondly, countries subject to the tax may retaliate by, for example, raising tariffs. They may do so if they view the carbon taxes as an unfair form of protectionism, or if they are developing countries. Developing countries are likely to retaliate, as a carbon tax that equalizes environmental cost pressures implies that they should shoulder the same level of responsibility for reducing emissions as developed countries. In this regard, developing countries have, in more than 20 years of climate change talks, argued that developed countries should bear primary responsibility for reducing emissions. This is because most of the CO2 that has been emitted was released by developed countries. As such, a tax is likely to invite strong retaliatory action from developing countries, making it costly to implement. Another approach to addressing leakage would be to establish a global ETS. However, this is likely to be very difficult to establish. A global ETS will require assigning country-specific emissions caps. However, reaching an agreement on these caps is not easy as countries have different views on how the burden of reducing emissions should be distributed. As discussed, ETSs offer a theoretically appealing way to curb emissions. However, there are challenges to implementing an effective ETS. Hence, other measures to reduce emissions should be introduced to complement ETSs. We'll discuss two of these complementary approaches here. Firstly, the way in which subsidies for renewable energy projects are distributed could be reformed to boost emissions reduction. Currently, subsidies often reward capital investment rather than energy output. As a result, a renewable energy plant that costs more to build but produces less energy could receive a larger subsidy compared to another that costs less to build but produces more energy. Reforming subsidy disbursement criteria to channel subsidies towards high-impact, cost-efficient projects can help further reduce emissions in a sustainable, cost-effective manner. While we are focused on reducing CO2 production thus far, another way of reducing emissions would be to discourage the consumption of carbon-intensive products. This may be done by labeling products based on their carbon footprint so that consumers can identify less carbon-intensive ones. On this note, carbon labeling has been introduced, but mainly in the West. Thus, expanding its use across products and countries can make it easier for consumers to adopt a low-carbon lifestyle. However, consumer preference also needs to shift towards low-carbon products for labeling to have an impact on emissions reduction. On this note, governments and civil society will need to enhance their promotion of a low-carbon lifestyle to complement labeling efforts. In summary, ETSs offer a theoretically appealing way to curb CO2 emissions. However, ETSs face implementation challenges, chief among which is the possibility of carbon leakage. As discussed, stemming carbon leakage is politically difficult and time is running out. Hence, complementary approaches to reduce CO2 emissions are needed. We've reached the end of our presentation. Thank you for watching. Goodbye.